It's happening right now. Millions of like-new R-vees just got dumped onto the market. Rigs that sold for $120,000 last summer are now going for under 25 grand. Dealer lots are jammed, lenders are panicking, and auctions are flooded with barely used rigs nobody can afford to hold. And here's the scary part. Some of these deals could destroy your wallet, because behind every bargain lies a desperate seller and a dying brand. Stay tuned. This isn't just a price drop. It's a full-blown R-vee market collapse. The lots are full, the phones are quiet. Drive through any major R-vee strip in Elkhart, Tampa, or Dallas right now, and you'll see the same thing. Dealer lots packed so tight you can barely turn a truck around. Rows of fifth wheels and motorhomes stretch like a parking lot frozen in time. What was once a summer of booming demand has turned into silence. The kind of silence you can measure in unpaid invoices. Dealers are holding inventory for over 180 days on average, nearly double the pre-pandemic norm. Some are quietly marking down models below their floor cost just to clear space for new shipments they never asked for. But the ads don't show that. They still say limited availability and factory fresh. In truth, the phones aren't ringing, the emails have slowed, and showroom traffic is down nearly 30% compared to last spring. When your sales team starts cutting hours on weekends, the busiest time of the year, it's not a slump, it's a warning. One dealer out of Missouri said it best: "We're not selling R-vees. We're managing debt with roofs." That's silence on the sales floor. That's the sound of an industry running out of credit. The truth is, those full lots aren't a sign of strength. They're a symptom, one that starts with factories pretending business is fine. Shipments say, okay. Cash flow says, crisis. Every month, trade associations like R-vee publish shipment numbers meant to reassure investors. On paper, shipments tick upward. Factories are humming, trucks are rolling, and press releases say production is stabilizing. But behind the scenes, those trucks aren't delivering sold orders. They're delivering unpaid units into dealer yards already overflowing with inventory. A leaked R-vee chart from this spring showed the truth. Shipments rose 12%, but retail registrations fell by 9%. That gap isn't just accounting noise, it's artificial activity. Manufacturers are keeping the lines running, not because of demand, but to avoid mass layoffs and loan defaults. Dealers call it forced inventory. They take the units, hope to sell later, and carry the interest until they can't. Cash flow is the killer here. The more unsold inventory sits, the more floor plan interest builds. For every $1 million in stock, the average dealer pays roughly $100,000 a year just in carrying costs. Add insurance, transport, and storage fees, and those healthy shipments start to look like a slow bleed. On paper, the engines are running. In reality, they're flooding. And the flood gets worse when the cost of money itself doubles. That's where the real collapse begins. If you've already seen dealers dumping rigs like this near you, hit that like button and drop a comment with your state. Let's map where the collapse hits next. The interest rate guillotine. 3 years ago, financing an R-vee meant signing for a loan at around 4.5%. Today, that same buyer faces 9.8%, and that's if they can even get approved. For most families, that's not a payment jump. It's a deal breaker. What used to be a $600 note just doubled to over $1,000 a month. For dealers, it's even more brutal. Every unsold R-vee on the lot is financed through what's called a floor plan. That's a line of credit dealers use to stock their inventory. When rates rise, those costs balloon. A dealer with $5 million in units at 10% interest burns through $500,000 a year just to hold them. That's before paying staff, utilities, or marketing. Some tried offsetting the pain with incentives, free delivery, deferred payments, or zero-down events. But none of that changes the math. Consumers are pulling back, and lenders are tightening standards. What happens next isn't theory, it's arithmetic. When interest eats profit, the collapse becomes inevitable. When interest eats profit, collapse isn't a theory, it's math. And when the math stops working, the headlines start spinning because the closures have already begun, just under a different name. Closures and corporate spin. In the last 6 months, over 24 R-vee dealerships have quietly shuttered, merged, or paused operations. Big names like Camping World and Lazy Days have closed regional locations, while smaller independents simply vanished from dealer networks overnight. But if you read the press releases, you'd think everything was fine. They call them strategic consolidations or efficiency improvements. To the staff who lost jobs, it looks like what it is: survival mode. In Elkhart County, the beating heart of America's RV industry, layoffs have quietly swept through suppliers who once couldn't hire fast enough. Component makers, transport contractors, and even paint shops have reduced shifts. Executives tell investors they're streamlining to prepare for an EV future, but insiders know the truth. Demand collapsed faster than they can spin the story. Every shutdown cut service options, warranty coverage, and parts support, hitting the end customer hardest. When you can't get your RV serviced under warranty because the dealer is gone, that's not market evolution, that's market exhaustion. They call it restructuring. On the ground, it looks like surrender, but this collapse isn't random, it's mechanical. And the next part reveals the gears grinding underneath. The used value slide. Drive past any used RV lot this fall, and the banners still shout "price drop" like it's good news. But inside the offices, managers are in crisis meetings. The used market, once the safety valve for new sales, has cracked. J.D. Power and NADA reports show that used RV values have fallen between 12 and 18%, faster than projections in the last 2 quarters. That means the equity owners thought they had. The value that made trade-ins work has evaporated. A customer who bought a travel trailer for $70,000 2 years ago might now find it worth less than $45,000. The trade-in value doesn't even cover the loan balance, leaving thousands upside down. Dealers can't take those trades without losing money, and that chokes new sales. The used market's collapse isn't just about resale values, it's about liquidity. When people can't move out of what they have, they can't buy again. That freezes the entire pipeline from customer to factory. When used prices collapse, new stock becomes radioactive. But the cracks go deeper than resale, because while the used side implodes, the factory books still show a profit, at least on paper. Wholesale wins, retail losses. Look at the latest earnings reports from the big manufacturers: Thor, Winnebago, Forest River. The headlines read "strong shipments" and "resilient market." But look closer, and you'll see what's really happening. The sales they're reporting aren't going to customers. They're going to dealers, fueled by incentives and rebates that mask the real story. A leaked quarterly statement from Thor showed that nearly 40% of its volume was incentive-supported. Translation: they paid dealers to take product. This tactic props up factory output but destroys the retail end. Dealers are sitting on too much inventory they didn't want, purchased with borrowed money, while the manufacturers book those deliveries as sales to impress shareholders. It's a shell game. Short-term profit for factories, long-term debt for everyone else. Dealers call it push selling, and it's burning them alive. One Wisconsin dealer admitted, "We didn't buy those units. They just showed up." When you combine rebates, hidden financing, and volume bonuses, you get phantom demand that looks like growth until the bills come due. They saved the quarter, not the business. And the bills always come due, especially when the product itself starts breaking faster than the company can repair it. Quality debt comes due. The boom years brought record sales, but they also brought shortcuts. Now the fallout has arrived in the form of rising warranty claims and product recalls. Internal documents from service departments show a surge of electrical failures, roof leaks, and slide-out issues on rigs less than 2 years old. It's not just one brand, it's across the board. The rush to meet pandemic demand forced factories to cut corners, and now every one of those shortcuts is a financial liability. Every recall represents cash leaving the company. The average warranty claim costs between $2,000 and $4,000 to fix once labor, transport, and parts are included. Multiply that by thousands of units, and weaker brands are bleeding out. Some have even delayed payments to service centers, forcing dealers to eat the cost just to keep customers calm. Those same dealers are now refusing new stock from the brands that left them unpaid. This is the invisible debt no balance sheet shows, the cost of rebuilding trust. But it's not rebuilding, it's eroding. Every recall is a withdrawal from a shrinking account. And for many dealers, the problem isn't the broken R-vees, it's the broken math behind keeping the lights on. The math dealers can't beat. At the core of the collapse is one brutal equation: interest versus time. Most dealers don't own their inventory outright. They finance it through what's called a floor plan, a rolling line of credit that lets them stock hundreds of thousands, sometimes millions, of dollars in inventory. When interest rates were low, that was manageable, but at 10%, the math is deadly. A dealer carrying $5 million in R-vees now pays roughly $500,000 a year in interest alone. That's before rent, payroll, advertising, and transport costs. Each month, those unsold units sit. They lose value while the interest meter keeps running. Even a small dealership with a modest $1 million floor plan is burning nearly $100,000 a year just holding unsold rigs. The system was designed for fast turnover. When the turnover stops, the business model implodes. Some dealers have tried creative solutions: joint financing, temporary partnerships, even offloading to liquidation wholesalers, but none of it changes the underlying equation. When interest outpaces sales, survival isn't about how many units you can move, it's about how long your lender lets you breathe. When interest outpaces sales, the next casualty isn't a store, it's a brand. And those brands, they're not theoretical, they're real names, some you probably trust. The towable price fighter. At the bottom of the list sits one of America's best-known budget towable brands, the one that made its name selling families the idea of freedom on a payment plan. But behind the ads and glossy brochures, the math has turned against them. Dealers leaked incentive bulletins showing that this brand now loses between $2,000 and $3,000 per unit sold, even before marketing costs. The company's quarterly filings confirm it. Rebates up 40% year over year, while retail deliveries fell by double digits. You can spot the collapse in plain sight. Dealer yards are stuffed with leftover 2023 models parked beside freshly discounted 2024s that no one is touching. Their new strategy, advertise instant savings on entry-level trailers, is just a polite way of saying, "Please take these off our hands." Suppliers whisper that several plants have already cut shifts to 3 days a week, and credit insurers have started flagging delayed dealer payments as elevated risk. Sell at a loss long enough, and your lender stops the game. But if the cheapest rigs are in trouble, wait until you see what's happening at the top of the market, where prestige has become a liability. The boutique Class A. Once the envy of luxury motorhome buyers, this boutique Class A brand is now fighting for survival. At its peak, these rigs sold for well over $400,000. Today, identical models are showing up at auction for barely $260,000, a 35% drop from their original sticker. Data pulled from Manheim's auction database confirms what private sellers already know. The so-called executive coaches are losing value faster than the trucks that tow them. Dealers have stopped taking trade-ins altogether. One Florida lot owner admitted, "We'd rather hold a used car than a $500,000 motorhome that won't move." Financing has dried up too. Lenders no longer want to underwrite six-figure loans on assets that could depreciate 10% in a single month. The company itself insists it's restructuring production for premium efficiency. But behind the curtain, supplier contracts are being quietly canceled and parts orders cut. Prestige doesn't pay the bills. Not when used rigs sell for half their sticker. And while the luxury names crumble, one heritage brand has lost something even more valuable: its identity. Subscribe now, because the next wave of markdowns is already forming, and we're tracking it first. Stay ahead, stay informed, and never let a dealer outsmart your wallet again. The Legacy Rebadge. It used to stand for reliability. For generations, this legacy American R-vee brand was a household name, built, sold, and serviced locally. Now, the badge on the front means very little because the company behind it doesn't even build its own rigs anymore. A leaked import filing shows that many of its latest models are being assembled overseas, then rebadged and sold under the old American nameplate. The problem? Tariffs, inconsistent build quality, and warranty confusion that leaves buyers stranded when something fails. Dealers say customers are already walking away once they realize the truth. One Pennsylvania service manager said, "Half the time, we can't even tell which factory built the chassis. There's no parts cross-reference. Warranty claims are bouncing between the importer and the reseller, with each blaming the other. The government tariffs designed to protect domestic producers are only making things worse, pushing retail prices up while reliability plunges. The trust built over 50 years is evaporating in less than 5. When even dealers can't tell who built it, buyers stop trusting it. But the chaos doesn't end with confused branding. It's also hammering smaller builders who depend on chassis they can no longer afford. The van converter? The boom in camper vans during the pandemic made this niche brand a rising star until supply costs flipped the equation. Their entire model line depends on chassis from Ford and Mercedes-Benz, and both have raised prices nearly 30% since 2022. Add higher labor costs, longer lead times, and a 10% financing rate on raw materials, and the math collapses fast. A supplier memo circulated this spring confirmed multiple production suspensions while unsold units sat waiting for delivery that never came. Buyers once paid $130,000 for a compact van conversion. Now, those same rigs list for over $180,000, but the market isn't biting. Dealers are canceling orders, financing partners are walking away, and secondary resellers are dropping prices by the month just to clear inventory. The company's official statement blames supply chain volatility, but employees have started leaking photos of idle assembly lines and unsent chassis stacked behind the plant. The conversion market that once symbolized freedom is now paralyzed by cost. When your base van costs more, your $130,000 camper turns into a $180,000 mistake. But the pain isn't limited to small brands. The next 5 are giants, and their fall will reshape the entire market. The diesel pusher on borrowed time. The big diesel pushers, once the crown jewels of the R-vee world, are now the heaviest anchors in a sinking market. These massive rigs were designed for a world where diesel stayed cheap and supply chains stayed predictable. Neither is true anymore. Diesel prices have jumped nearly 40% since 2021, and DEF, the fluid needed to run these engines, is now in shortage across multiple states. Service bulletins from Cummins and Freightliner show months-long delays on basic components like filters and sensors. Dealers are parking unsold Class A diesel units behind their lots, waiting for parts that never arrive. Each mile of transport now costs almost twice what it did 3 years ago. Owners who once filled tanks for $300 now pay over $600 for the same trip before maintenance even begins. Extended warranties don't help much when there's no technician available to fix the problem. Insurance costs have climbed too, as replacement parts are backlogged for months. The result? Every luxury coach becomes a liability the moment it leaves the factory. When diesel becomes a liability, every luxury coach becomes an anchor. And when fuel can't move your product, the next play is consolidation, combining brands to survive one more quarter. The sister labels Cannibalized. 2 once distinct brands, long positioned as premium and practical, now share the same production lines, the same floor plans, and even the same parts bins. Inside the factory gates, these siblings are being merged under one roof to cut costs. Leaked rebranding memos confirm it. Consolidation will create operational efficiency and brand synergy. Translation: one of them won't make it. Dealers already see the fallout. Units arrive with hybrid logos, leftover parts from both brands slapped together under one badge. Warranty systems can't keep up, listing expired VINs that no longer match active records. Buyers are told their model falls under the combined umbrella, which means confusion when service is needed. The merger saves a few million in overhead, but erases decades of brand identity. Employees whisper that one name will disappear entirely by year's end. What customers see as updated branding is really the final consolidation before closure. When the logo changes but the warranty doesn't, that's not innovation, that's triage. And as mergers blur identities, one major manufacturer faces something even worse: production that's grinding to a halt. The motorhome maker with a vanishing pipeline. In Elkhart County, the beating heart of American R-vee production, this brand's factory floor once roared with the sound of steady work. Now, it's quiet. Conveyor belts sit idle, shift lights stay dark, and entire wings have been cordoned off. A local layoff report confirms more than 200 workers cut since March, and suppliers that once delivered cabinets and wiring harnesses are closing their doors. Executives tell investors they're right-sizing operations, But insiders say it differently. We're running out of orders. The company's backlog, which used to stretch 6 months, has evaporated. Most new builds are speculative, units made without a confirmed buyer. Every day that a production line sits still, fixed costs pile up and morale sinks lower. Subcontractors describe a chain reaction: fewer chassis orders, fewer parts shipments, fewer paychecks. Dealers report long delays for promised deliveries, and some have stopped taking pre-orders altogether. You can't sell what you can't build, and by summer, they'll build almost nothing. But the biggest danger isn't one brand falling behind. It's when the entire network sits on top of the same mountain of debt, the debt-heavy roll-up. This is the company everyone knows by name, the giant that owns multiple R-vee brands, parts suppliers, and dealership networks under one corporate umbrella. On the surface, it looks unstoppable. In reality, it's cracking under the weight of its own acquisitions. SEC filings reveal more than $2 billion in combined debt, with interest costs rising faster than revenue. Credit agencies have quietly downgraded their outlook from stable to negative. Internally, the tone has shifted from growth to damage control. Hiring freezes, canceled expansions, and halted research budgets have replaced the optimism that once defined this empire. Dealers whisper about late rebate payments and canceled promotional support. Analysts now use a new phrase to describe the company's trajectory: controlled disassembly, meaning the slow breakup of assets to stay afloat. Stocks have already fallen nearly 50% since early 2024, and the company's CEO insists that strategic adjustments are underway. But read between the lines, and it's clear this isn't strategy, it's survival. The R-vee market's unraveling fast, and this is just the beginning. So before you buy, sell, or trade, watch what happens next. If this opened your eyes, drop a comment with your state. Let's map where the collapse hits hardest. And don't forget to like, subscribe, and hit the bell, because the next wave is coming soon.